I hope you are warm wherever you are. We're going to start shortly. I just want to double check if the sound is working. I'm just checking with my staff on my side.
I can hear you.
Thanks, Ange. Okay, perfect. Sound is confirmed. Right, I'm going to switch off my camera and then we can get started. Right, so for you that has been in these sessions, you'll know the drill. Please note that your microphones are muted. You do get your CPD points, and if you do stay for the whole webinar. If your signal's lost and you can't hear us for a bit, you're welcome to ask in the questions if everybody else has the same issues. But if not, you can just stop and join again, and that should solve your problem. And as always, the recording will be made available. The rest of the series is available on YouTube already. So if you do want to go back to any of the sessions, you're welcome to do so. You'll find it on our YouTube channel. Then, as I say, please use the question chat panel to interact with us. I will be doing the XBRL bit, and then afterwards, Angela will be doing the cash flow. So I know you've got loads of questions about the cash flow. So please get them ready, and you are welcome to put them in the questions. Right, like I said, I will be doing XBRL for those of you that haven't met me. My name is Ninka, and I'm the product manager for the financial statements. Afterwards, Angela is going to go through very much detail in the cash flow and the cash flow worksheet and how it all comes together. I know there's been a few questions throughout the series about it, so please stay for that after. Right, so let's start with XBRL. So why XBRL? What is XBRL? So XBRL is a freely available and global framework for exchanging business information. It's all about function, while iXBRL takes that function, puts it into a format that is more accessible and visually appealing for the user. And then CIPSI mandated on 1st of July. So that's now very high level, but if you look into the detail, what this means is XBRL is similar to our mapping structure. It is used globally. So what they are trying to achieve over the long term is that reporting can happen and can be very much more comparable within regions, between regulators, because everybody's using the same tags. And if you look at the tag as like a mapping number, then you'll understand what I mean by that. So I will go through the product and show you in more detail, but what's very important to note is the CIPSI is mandated, but from 1st of July, certain companies must submit XBRL financials, and I'm sure a lot of you are very familiar with it. And then, excuse me, as we go along, they will be adding more compliance requirements for it. So for us, we've got it in several of our products. We've got it in IFRS and SME, and then we have IFRS Lite and SME Lite, and I will also show you those. And then we also have it available in GRAP. So if we look at the requirements, firstly for companies which has come through in 2018, you'll see that there's certain requirements of when you need to submit XBRL. So firstly, if you have a PI score that's more than 350, or if it's internally compiled, then it must be at least 100. If it is a public company or a state-owned company, you have to, and then you can read through the rest. The one that always seems to, or the ones are the most applicable is the first one, your public interscore, and then your last one, your MOI. So if your MOI states that you must be audited, irrespective of what your PI score is, you then have to submit XBRL. So we do see a lot of companies that are very, very small but still need to submit XBRL because their MOI requires an audit. Then in 2021, GRAP became mandatory, and that has to file XBRL. And in 2023, entity type co-ops needed to submit as well. So this is all just requirements for CIPSI. But they are looking to expand it to other regulators like the JC, like the like SARS. But you really, at the end of the day, only submit your data once, and then each regulator extracts what they want from this data. But we are not there yet. Where we currently are is it's only for the company's house. very, very important to note is that the due date for your XBRL is 30 days after registration date of your company. So this makes it sometimes quite tricky because it's not part of your financial statement process. It's actually quite disjointed if you want to look at it that way, especially if a person who's preparing it is not submitting it. So if you have, let's call it a 30 December or 31st December year end, and your registration date is in February, and you're not done with your financials, then what it means is you will submit the latest set that you have, which will be then the previous year set, which you have compiled probably a year ago. So it is important to see how you can streamline the process to be as efficient as possible because of this, if I want to call it, disjointing of your year-end and your year-end processes. Right, without further ado, let me go into the financials, and I'm going to show you what we do in the set. So I'm going to show it in IFRS, but it is exactly the same as in SME. So if you draft in IFRS, sorry, on our full template, you'll see that this is already included in the financials, which really is beneficial because it's pre-tax, it's included, and you can really, at the end of the process, just go through the XBRL with not a lot of effort from your side. So if I just jump to my balance sheet, you'll see here's my balance sheet, but you'll see I have some funky colors here at the bottom, which you normally don't see. So as soon as I click on this XBRL button here at the top, then what will happen is this ribbon here will appear, which will give me more XBRL requirements, and the mandatory page here at the top will also show. I'm going to come back to the mandatory page, but just let's first look at the tagging. So if you look here, if I click on review tags, then what will happen is it will show me where these amounts are tagged. So if I just hover over PPE, you'll see here that it's the tag is the blue highlighted at the top. Then the second blue, excuse me, is the period, and then your last one is rand. So like I said, all of this has been done up front, so there's nothing really that you have to do here. You can review it, and we do recommend that. And if you really feel that something is incorrectly tagged, you can also change it. So say, for example, I go to loans, let's go to trade and receivables, very sure that is right. But say you want to go and change the tag. So like you can see on the left-hand side of my screen, the figure is then circled in red. And then on the right-hand side, this HTML comes up, this dialog box, which is basically the tagging. So if I just show you a bit more how it looks, you'll see there you have your categories, and then as soon as you go into one, your subcategories is here. And maybe just a step back, where does this taxonomy come from? Is the IFRS board each year with the IFRS and the SME standard issue a standard IFRS taxonomy and an SME taxonomy that goes with the standard at that point in time. So for example, when rights of use of assets came in, then the next year you'll see, excuse me, when the standard is issued, then the next year the taxonomy will come in, and normally the year after, it will then be mandated and effective to disclose it. So normally it's a year before it even is effective, we'll have the taxonomy available. What CIPSI then does is they take that taxonomy and they add a few additional fields. And when we go to the mandatory page, I'll show you a few of them. So the taxonomy, like I said, global, it gets done by the IFRS board. CIPSI takes it and say, we need this additional disclosure, and then that taxonomy gets released to us, which we then implement in the software. Right, but let me get back to my tagging. So say, for example, this trade and other receivables, I don't agree, I want to change it. You can go remove tag here at the top. And then I can go and say, right, that was more non-current inventories. Doesn't make sense, but let's say it is. And then I can go and say, okay. And now you'll see if I hover over it, that one has changed to non-current inventories, but it's just for the current year. If you want to do it, you have to go through each year and change it for group and company. Okay, so that is how you change tag. Don't really see a lot of that happening, but you do have the option to do it. Then while I'm on this screen, I just want to show you this report here at the top. So you get two reports here, the Excel and the HTML one. I will show you the difference between them, but you can export this in a way that if you need to give it to somebody to review that doesn't have Caseware, then you can use those two reports, but I'll get to that once in a bit. If I then go back to my mandatory page, this is the information that CIPSI required and then is validated when you submit successfully. So this is quite important. Some of the information is available on your financials and on your info store, but some of them you have to complete. For example, the customer code here at the top, that is your CIPSI customer code. And if you don't have that included, you will see this validate and export here is grayed out. But even if it wasn't, it wouldn't be successfully submitted. So what we are trying to achieve here is we want to make sure that you can actually, as far as possible, have a positive submission without having to come back into the software. So that's why we don't let you export until everything here is complete. But obviously we can't check, is this customer code actually the correct customer code? So we can just make sure that it is completed. So like I said, some of this information pull through, like here you'll see the partner's name, that will pull through from your information store if you've completed that. Your PI score will complete, but then some things like, for example, this drop down, you will have to go and make a selection there. So basically you'll go through the manager page and complete it. And there at the bottom, you'll have what we call footnotes. So certain items, excuse me, in the financials, you must have a value. So when it is null, they're asking for an explanation on why it is null. So one that comes up very often is the OCI, because we don't always have it. And then what you'll do for this is you'll click here on the red button, and again, you will give a reason. Current year recorded, and you can save that. As soon as that's saved, you'll see a green tick here. And then if you see the green tick, you'll see the validate and export is then there available for you to export this. Okay, so when you click on the validate and export, which I'm not going to go through now because it is going to take some time, it goes through various processes. The first process that it does, it double checks that there's that everything adds up, that there's not $1 differences in those kind of things. And then what it does is does a Caseware validation from a technology point of view. And then what we've added is a CIPSI validation. So I'm quickly going to jump back to my slides because I took a screenshot just before. And this is how it will look. So what this validation does, it links up to CIPSI's a test portal that they have with an API. So it's a live system. And it checks that if there's anything that will come back with warnings or errors. So you'll see here that I only have warnings. For example, the first one in the 2021 taxonomy, they have changed the PI score that it always rounds down, wherefore from a psycho perspective and a regulator's perspective, it should be mathematically done. So there might be a $1 difference there. So you'll get an error there, or sorry, a warning there because of that rounding up or rounding down. So you'll get a warning there. And here, for example, another one was the equity that you should be reporting on. And here we say, go back to your statement of equity, ensure the line is turned on and tagged correctly. These ones happen quite a bit if you have a line that's not printing because it's null. So again, just to double check your tags and then you can submit it. All of these are just warnings. So this means even if you validate and export it, it will be successful on the portal. This is what a warning means. An error means it will not be successful and you need to go back and fix it. So with the screen, we have here the bottom export list. So if you want to export this and then have your file open on the one side and the list on the other side that you can see what you need to change. And then you can decide to keep the file or discard the file. So if I jump back to my financials, after you've validated and exported, what it will do is it will come in here and it will show there. So it is very important to note that because this is, like I say, a live portal with CIPSI, there is certain elements that can make that the validation can't happen. If you have a slow internet, if there's a dip in your internet on their side, if they've got issues, then it can't do the online validation, obviously. What will happen then is it will also give you a warning to say, we can't validate and export it at this point. Do you still want to export it or not? And then, like you say, this folder is past online validation. If you've chosen that they were perhaps offline at that point, then you'll have another folder that says did not pass, and it will go in there. Just for the reason that, like I said, sometimes the personas that work with these, the person that drafts it, the person that then exports it, the person that submitted, it's not always the same person. So you can still export it, even if there is issues, like I say, in any of those instances. Right, then, like I said, you get some reports, and then this is the 2 reports that you get. So if I open this one, let's drag my screen over, you'll see this is a review report. So if you hover over it, like there, for example, you'll see where it is tagged. Like I say again, if you need to send it to somebody that needs to review it, that doesn't have Caseware, then they can come in here and they can use it and tell you what do you need to change. If I open the actual file that's going to be submitted to SIPC, which is this one here, you'll see it looks exactly the same. It just doesn't have the tags. And that is the difference between XBRL and XBRL. So this is the one that you will submit, and it will have, like I said, all the details in that you require. Right. Let me go back to my next slide. Okay. So that is XBRL in the full templates. Like I say, it comes included, it's pre-tagged, and you really have to go through the mandatory page, fill in what's not filled in, review the tags if you need to, and you can validate and export. Then we have another product that some of you might use, and it's called XBRL Lite, and we have an SME one and we have an FS one. What the XBRL Lite was intended for is if you have a set of financials that's not prepared on Caseware, so you've got a client, but set of financials was done, you've got the PDF, and now they come to you and say, listen, you need to submit this to XBRL, how can you do it? So that's what the XBRL Lite is for. So it works a little bit different. Firstly, that it's per token base. And then as soon as you install it, you will get this pop-up screen, and then what you'll do is you'll have a firm ID that you put in here, and automatically it will activate one of your tokens to be used for this engagement file. So how this is different than your financials, your full financials product, is this is, if we're going to call it a skeleton with all the taxonomy included, and you can copy and paste from your previous year's set or from your PDF to have this available to submit to XBRL. So definitely a more manual process, because it's not, although it's pre-tagged, you have to put the information from your PDF set in it to be able to export. But if you want to assist your clients, this is definitely a very effective way that you can do it. So let me show you just quickly how the XBRL Lite looks. Okay, so I'm going to start my balance sheet, and you'll see, like I say, all these fields are input. So you will have to come in here and populate everything. Statement of equity, your cash flow, and then for your for your accounting policies, even you have to copy it over. It is very important to note, we liaise with SIPC on a monthly basis. We have a very good relationship with them to make sure that these projects are successful. They are not that concerned with the format of the XBRL. So if you say I have a table that you copy from your PDF set to your XBRL Lite or any other product that you use, if the table doesn't look exactly the same, the format of it, that's not going to be a concern for them. They really want the information of the financials, and your information of your XBRL file must be exactly the same. But the formatting, especially with these that you have to copy over, is not a concern for them. So, and then there is all your notes at the bottom. If I then go up to the top, again, you'll see my manager page, exactly the same as in the full set. And the rest of it works exactly the same. You can also, as soon as it's complete, you can validate and export, and you can submit it then to the SIPC. Okay. And that is it from me, from XBRL. I'm just going to quickly check if there's any questions, because I do see some questions came in. Just give me a second. This thing doesn't want to work today with me. I can see there's a question, but I can't see the question. Okay. Right, so I've got a first question. Is the XBRL compulsory for the company types noted by Ninka in SA only? Yes, so the XBRL for SIPC is required only in South Africa. But that being said, we have seen an increase in certain countries in Africa that they require the XBRL taxonomy, but IFRS and SME that gets issued by the ISAB board, but that needs to be used in different countries. Then also in different regions, not in Africa, like in the UK, for example, they use a taxonomy even for their tax submissions as well as their company house. And I believe in Australia also, they're going down that path. So it really is used differently. We haven't seen a big drive in Africa to regulate it or to make it compulsory. At this point, it seems like they are still working out exactly who's going to be applicable to and who not, but we definitely have seen an increase in those kind of questions. Okay. Then I've got a next question from Rafiwa. There's a question, and I'm going to just jump back so that, excuse me, to my XBRL file. There is a question. Confirm if all the applicable file reports are included in the financial statement. Does that refer to them being included in Caseware or just the company has them? For example, the Social Ethics Committee report. Okay, so this question, so it is one of the questions here. So about, I want to say 2 years ago, let me just go to editing and enable that I can show you the report. About 2 years ago, SIPC came to us and said, ideally they want the financials to look exactly like the XBRL. I mean, that's the requirement that they have. It's not like a nice to have, that's the requirement. We found it challenging because like Rafiwa, like you're saying, it's like not all the reports is in the financials, right? We have even your audit report. It's never going to be really in here. You might print it and it might be the final version, or it might be that your client has prepared the financials and you just slot the audit report in. So to accommodate for that, I'm just going to go down. We have included, if I now go to the Social and Ethics Committee report, we've included the functionality that you can put in an image of that signed report. So here you have a blank report, and then you have here insert image of this report. So we've included this functionality in all the reports. So what you can do is if you click on that, you'll see there's a new toolbar coming up here at the bottom, and then you can add an image in there. So again, you could just take a screenshot of your Social and Ethics Committee if you don't have an image of it, and you can put it in there. And then at the end, your XBRL file looks exactly like your Caseware file. I hope that answers your question. And then online validation filing. So there is, like I mentioned, a few elements of the online validation, and what does cause it sometimes not to work, so it doesn't submit successfully, or the online validation file. So internet connection is a big one. If SIPC is working on their site, on the portal, the API, if they have a different internet. So it really is dependent on both of them. If you do continue to struggle, then it's very important that you reach out to support. There is also access rights on your folders, but you have to make sure that you can write to your Caseware folder. So there is an element of the same like when you install your software, your Caseware software, that you have to have admin rights. So normally if I found on my PC even, if my validation doesn't work, that is normally the case. So there is a document or FAQ on it. So what I will do is, as soon as Angela starts presenting, I'll have a look for it and I will put it in the chat for you. So maybe check firstly if you have access to your folders, if that is correct. And then if it is still not validating and exporting, then please reach out to our support team to help you. Then I've got another question about the XBRL Lite, about the pricing. It is it is separate pricing. It is, like I said, per token that you use, because you are going to bill that client X amount. So we didn't want to make it that you could do unlimited, because some people would use it for one, some people might use it for a lot. So that is per token, but you pay additional for that. Okay. Right, thanks, Rafiwa. I see your feedback on there as well. Okay, great. That looks like all the questions that were for me. If there is any other questions, you're welcome to pop them in. Like I say, while Angela presents, I will have a look at them, and then I'm going to hand over to her. Thank you, everybody.
Thank you, Ninka. Ninka, I just want to do a sound test on my side, please.
Yes, I can hear you.
Perfect. All right, everybody. Thank you for joining us today. Please stay after that very interesting session. Cashflow worksheet, I think just as riveting. If you do hear a clattering sound in the background, please excuse me. It will be my teeth. I'm not sure how life is on your side, but it's freezing here. I saw something interesting the other day. Apparently nothing surprises a South African like winter every year. Don't know why that is. All right, so let's get on with it then. We're going to take a look at the cash flow worksheet this morning. I have previously been through the cash flow worksheet with you. For those of you who haven't been in that session, like Ninka said, it is available on YouTube. In that session, we just discussed how the cash flow worksheet integrates with the cash flow statement, and I don't want to rehash that session. What my objective is today is to actually literally work through a cash flow statement with you so that you can see the process that you would follow. Okay, so the first thing when you get into your cash flow worksheet process is just a few things to make sure that you are on top of. It's important, I've mentioned it before, that you accurately map your trial balance. Sometimes you might be tempted not to accurately map income and expenses or gains and losses, for example, because perhaps some items might not be displayed, and you might be tempted to just map them anywhere in the income statement mapping. Your problem there is that particularly if it is a non-cash type of transaction, is that it's not going to pull through to the correct line in your cash flow worksheet, which means that you're going to have to do extra work to bring those non-cash movements in yourself. Before you start the work, just make sure that all notes are completed, particularly your reconciliation notes, things like property, plant and equipment, investment property, other comprehensive income. The reason for this is because the cash flow worksheet utilizes both trial balance information and as well as notes from other sources within the financial statements. Where possible and where it's obviously a non-cash transaction, then the cash flow worksheet pulls that information through by itself. When you're happy with your mapping and with your note completion, then just refresh the worksheet so that you can pull that any changes will pull through. And then you're going to set up to identify and insert non-cash transactions. A lot of them, and in the most part, most of them would have automatically come through in the process, but you would have to sit and take a line-by-line item or look through your cash flow worksheet to identify if there are any non-cash transactions which have not been automated, and then you will bring those in. I've just made a note here to also consider profit or loss when you're looking for non-cash transactions. Unlikely that there would be a non-cash profit or loss item other than what we would have mapped, things like depreciation, fair value adjustments, gains and losses on disposal. But there might be, as a random example, perhaps a donation received of not a donation of cash, but a donation of an asset, and then that could have been included, say, in other income, and that would then be a non-cash transaction, which Caseware would not be able to identify. So I'm just saying to look out for both your balance sheet items and profit or loss items. And then remember both sides. Whenever you're working through the cash flow worksheet, for every debit, there is a credit. So you have to, if you've made sure that you've put both sides of your non-cash transactions through, you should be okay. And I guess basically a good way to identify a non-cash transaction is to ask yourself, if the transaction was obviously a debit and credit and none of those answers were bank, then you can be satisfied that it wasn't a cash transaction. So that's probably just a good go-to place. Okay, then types of non-cash transactions. The types that are automated by Caseware would be if you have a transfer between asset classes. For example, you know that investment property can be transferred if it changes its use between property, plants and equipment and inventories. Those transfers are obviously not cash in nature, so that would come through as a non-cash item. This is only going to be pulled through if there's a detailed reconciliation. So those are basically going to be your non-current asset notes. They have got a reconciliation as part of the disclosure requirements. But if your transferred asset is something like inventories, then you know that there is not a reconciliation of inventories note, and so that would not be automated. So there's an example of a place where you would have to go and manually insert the other leg. Okay, depreciation, amortization, impairment, gains and losses on disposal, fair value, forex, and so on. These non-cash transactions, if you have correctly mapped them, this would automatically pull through. So by correctly map, I mean to the right category. So if you've got a gain or loss on disposal of PPE and you map it to gain or loss on disposal of investment property, for example, it's going to pull through to the wrong line item. All right, then deferred tax, the movements on your deferred tax, if you've mapped them as well correctly, these are also going to automate in the non-cash transactions and your other comprehensive income movements. So really a lot of it is automated. Types of manual transactions, which you would just have to go and apply your mind for. I've already mentioned assets where the movement, where there wasn't a reconciliation and there was a transfer to or from the asset class, then you would have to put that in manually. Non-cash capital changes. This would be something, for example, if you acquire property, plants and equipment through a leasing transaction, then this, if it's been allocated to PPE, which is allowed under IFRS, or if you're in the SME standard, it would be allocated to PP&E because there is no concept of the right of use asset in the SME standard. So that would, if you've leased an asset under a finance lease in the current year, I'm talking now, I'm using finance lease terminology, so I'm speaking to SME, that asset would appear as an addition, but it was not a cash addition. But Caseware won't be able to identify how much of the additions are cash and non-cash, so that you would have to insert. And then I've already mentioned non-cash donations, say of assets, would have to come out as well. Okay, let's go through an example because I think it's the best way to see what's actually happening here. I'm just going to go into my my file. So I've created a SME file. I have fully mapped it and I've balanced what I can. I have completed my notes, and you will notice that my statement of cash flows is out of balance in the current year. So if I go to my cash flow, I just want to show you that it is completed. So I've done the process, I've completed all my notes, and I've run my refresh. So that means that all my amounts have pulled through to my cash flow as we looked at last time. And my current period, it was a first year file, so I manually input my comparative figures Just a reminder though that after the first year, the current year figures will always roll over in the year-end process. So you would never have to recapture your comparative column. But let's go and see now why our file is out of balance. So I think we can start by jumping to the cash flow worksheet. You can do that by clicking on this link, which I already have done. And then it opens up the cash flow worksheet tab. Just a quick reminder what it looks like. There's a document map on the left-hand side. Our cash flow worksheet, which is the heart of the document, where all the calculations take place, is now displayed on the right. This is set up as a statement of financial position or a balance sheet. It lists all of our assets down the left-hand side. So whatever you have on your statement of financial position will present here. And obviously only items that do have amounts mapped to them will appear. So we've got all of our assets, excluding cash and cash equivalents, because that is the answer, right? That's what we're working toward, because we're trying to determine what the cash flow is for each balance sheet line item. That is the approach that we take. The reason we did this is for the sake of completeness, because if we know that we've looked at all of our balance sheet items and our cash flow balances, then we know that we've missed nothing out. Okay, then it's followed by equity and liability. So first our equity section, share capital, reserves, so on. Retained income we split out. I explained that last time, because retained income, the movement in retained income represents net profit. And then we've shown you all the non-cash items that are taken out of net profit because they disclose separately. So instead of putting it in one line, we've actually just split it. So this is just a collapse or an expansion rather of retained income. So we go through our items presented separately, and once we get to our items presented separately, we basically finish retained income, and then we move on to our liabilities. So dividends paid, tax paid, loans from group companies, all our liabilities, and this would cover our entire balance sheet. So obviously, if we take our full movement, which is the movement of everything above, all our assets, equity, and liabilities, excluding cash and cash equivalents, we compare that to the movement on cash and cash equivalents. If our answer is 0 at the end, then we know that we have accounted for everything. So at this point in time, we do not balance. And if you land in this position, so we've imported our trial balance already, we have populated all our other notes, and yet we're not in balance. And the reason for this could either be incorrect mapping, or more likely, there is a non-cash transaction where Caseware has picked up one leg in one of the balance sheet line items, but the other leg was not detectable. So that's why you're going to go through each of your lines and just try and find missing items. Most of it will be a review process. And if you don't have significant non-cash items other than the typical types, then you will probably be in balance straight up most of the time. So let's go through the process. Oh, and sorry, just before I skip a step, it starts with our opening balance. Then we've got a whole host of columns, which are all our non-cash movements. So we say we started with our opening balance, we put all these movements through. If we minus our closing balance, it means that the remaining answer was the cash movement that went through that line item. Then the cash movement for each line item, we take to the rest of the work paper, which is cash flow from operating, investing, and financing activities. And we drop them into these categories based on their nature. And it's here that they are split into the type of cash flow. So for example, here we see a net cash flow on PPE of minus 878,000. It's in the investing activities section where we're going to disclose, well, what was that? Was that proceeds or disposal? Was that purchases? And so on. Okay, and then our test of cash flow is just another final test to make sure our answer is 0. So it takes our movement calculated in the 3 sections above. It takes the opening and closing balance of cash, and we expect a 0. Okay, that's all the background. Now we can go through the process. So we're looking at property, plant, and equipment. Obviously, you have to know what's going on in the business that you are accounting for. So you're going to want to find out from your client or from your audit process so far what were the movements on property, plants and equipment. So obviously Caseware is going to make use of the PPE recon. So let's go and take a look at that recon. I'm going to go to my balance sheet. I'm going to go to my reconciliation. And if I take a look here, I can see that obviously it's able to look, it can look at additions, but what we can't tell from additions is how much was cash and how much was non-cash. So this we have not been able to deal with. Disposals, okay, business combinations, I don't want to really touch too much on because we haven't looked at consolidations yet. But if you're in a place of business combination, at this point it would be a manual process. The reason for that is there is a lot of calculations in the background to get the items to the cash flow worksheet. And obviously, compounding calculations is also a potential speed issue. So we decided at this point, because of the relative volume, what's the word I'm looking for? It's not something that occurs all the regularly, a business combination, that it would be better to save the speed and the space and just keep that as, because it's a once-off, leave that as a manual process. So if there should have been an addition through business combination, that would be one of your items that you would type into the cash flow worksheet. So just keep that in the back of your mind. Okay, disposals. We've assumed that disposals are cash. That was an assumption made. However, if the assumption is wrong, you can overwrite that in the cash flow worksheet and remove the amount. But in the interest of the calculations, we have assumed this would be cash movement. Transfers between property, in this case, we've got a transfer to inventory. Transfers we know would be non-cash, so case we would automatically take transfers out. Revaluations also we know are non-cash, would automatically take it out. And then we can see like depreciation, impairment reversal, these are non-cash, would automatically take it out. So you can see a lot of our movements, if we go back to our cash flow worksheet, are already sitting there. So there's our transfer, case we already put it through. It's the yellow cell, meaning that you could override that. And of course, and there's your non-cash capital additions. There's nothing here. But what I do want to tell you about this specific set of financial statements is that in the current year, we entered into a finance lease, and this is SME, remember, so I'm using finance lease terminology. And of course, the reconciliation of PPE was not able to identify that. So this is a non-cash movement which we must enter. When you put your non-cash movements in, you enter them in the direction that they impacted the line item you're looking at. So if we added assets through a finance lease, it meant that our PPE was debited or increased. So I'm going to put the amount in. It was 846,958. So I'll type that in. And you would see that it immediately then obviously reduces the cash portion. So this just means that of our additions, there was a portion that was non-cash. And if I had a business combination, I would have typed that in there as well. Through other comprehensive income, this picked up from, so the other comprehensive income column, in this case, it picked it up from the PPE recon, but it would also pick up, I will show you when we get further on, from the other comprehensive income note, which is why it's important again that that note be completed, and we dealt with that 2 weeks ago. If you weren't in the session, you can catch up on the recording on YouTube. Right, then we get non-cash through profit or loss. Just beside it, you see there's another column for other non-cash through profit or loss. The reason why we've given two columns is just so that it didn't create confusion. So our first column, which is white, which means it's a calculated cell without the ability to override, so that you could, if you had to add any other item that impacted PPE, that was through profit or loss, but wasn't your typical depreciation and so on, that you could type it in here and not confuse this amount. So that's the reason for the two columns, but it's both a through profit or loss amount. Also just want to point out that this is just a calculation worksheet, and so it's not as if these columns are going to have specifically tie back to anywhere in the financials. So if you don't use the right column, it's not the end of the world, it's just going to be difficult for you to identify what you've done. What you can also do, while I think about it, is it's possible that you might have 3 or 4 transactions that you add together in a specific cell. then just go and make use of the annotations and create a note. And then you could just describe in the note what made up the amount. Okay, right. So now I've looked at property, plant, equipment. I want to show you how can you tell what's in this amount here. So if you do a trial balance drill down, so I'm going to right click trial balance drill down, it's going to bring up all the accounts that were involved from the trial balance in this line. So not everything is on that cell. However, this is the non-cash through profit or loss item. So we know it's our income and expense column. So what you can do is you can just analyze. You can go into your trial balance drill down and just go take a look here at the class. And you would see that you're interested in everything that's profit or loss in nature. So it would be all of these items. So you can see, oh, it was all my depreciation amounts. There's revenue. Oh, it was a gain and loss on disposal also came through here. And so through that process, you can identify how this amount of 623,000 was derived. There was a profit or loss on disposal here, and the reason why it's included in this cell, even though we know that the actual profit or loss on disposal doesn't impact the PPE line item, we do know that it's part of the calculation of proceeds on disposal, and so we bring it in here as almost a nominal non-cash movement, so that it would by default land up in your net cash movement, including the net profit, the profit on or loss on disposal, so we can get the true cash amount. Okay, so now you've analyzed, so the most of it you can see was automatic. The only part that we've added is the lease amount. And then I also want to tell you that you found out that there was a donated asset to the extent of 24,000. And this asset it wasn't a capital donation, it was just some kind sold, the donation was recognized in other income. So here we've got another addition, but it wasn't a capital addition. This was recognized through profit or loss. So let's just put that in. And it would also have been in the additions column. Now it's obviously you're going to be looking at material amounts, so just pretend that this is material for our purposes. So now we're left, can you see how very small our amount is? And if we had not taken out the non-cash transactions, we would have misstated this. So now what we do is we take that net outflow of 7,000 and we're going to analyze it in its the section of the cash flow worksheet where it belongs. We know that property, plant and equipment belongs in investing activities. So we go to our investing activities and there we see that there is a section for property, plant and equipment. So this work paper set out to look like what you're going to see on the cash flow statement itself. We've got some columns here. Our first column, default cash flows, is where the answer from the first part of the worksheet is literally just dropped in. So it's like a Dropbox of sorts. We've picked, of the type of movements in property, plant and equipment, we picked the most likely default. So we said you're most probably going to purchase PPE more than you're going to sell it. So we've dropped it in there. The second column says reclassifications for cash flow line items. This is where you say, no, not all of that amount was a purchase. There were also proceeds. So we're just going to, this column is to reallocate from the one line to the other. And it will always be equal and opposite, because what you've calculated in the first part of the worksheet as the cash flow from that item, that has to remain true. So, if you're going to reclassify it to the bottom line, then it comes out of the top line. So that your statement of cash flow column, this is the items which actually pull through to the financial statements then. So in this case, you would see that it would be cash purchases of 67,000. And there was a disposal of 60,000. Just want to add for you as well, where Caseware is able to calculate the other line amounts, it does so. Again, it's the yellow cell, so you can override it if you disagree. Most of the time, it's going to be an allocation process where you would have to look at each one and change the allocation. You will never be able to change the net cash movement though. All right, so in this case, Caseware was able to go and fetch the disposals amount from the reconciliation table. It was 77,000. But there was also a loss on disposal If you go to our income statement, it was a loss on disposal, so it's going to be in operating expenses of 17,000. So it takes that loss into account, adds them together, and it says that your proceeds from sale were 60,000. So it works it out for you. If you say, no, that was never a cash disposal, then you would just get rid of that 60,000 and say, no, it wasn't for cash. Okay, and then it adjusts the sale. If you make a mistake here and you override a calculation, you can just right-click, click on the overridden, and it will give you the answer back. Okay, then let's see how this then gets to the financial statements. So it's just the end column. If you go back to the cash flow statement, to the investing activities section, and now you can see we're even more out of balance. Don't panic. It's because we've only put through one leg of each of the non-cash transactions that we've dealt with. Okay, we've got purchase of property, plant and equipment, and proceeds from sale. And again, you can't change these amounts. So it's to maintain the integrity of the worksheet. Right, so let's go back to our worksheet. We've dealt with property, plant and equipment. We're happy that we've assessed that, worked with everything here. We're then going to go and look through all of our balance sheet line items and almost just review the process and consider if we're aware of non-cash items that should go through each line. So our intangible assets, we had an opening balance, less a closing balance, and we see that there was a movement through profit or loss on our intangible assets. Let's go make sure that we're comfortable with that it's all non-cash. Remember, we've completed our notes already, and we see that in our intangible assets reconciliation, there was only amortization for the period. So we are happy with that. Let's go and cross fingers and thumbs that that's the same number. 89,572. I'm just joking. We've tested this a gazillion times, so hopefully we've picked up if there's anything incorrect. So there was no cash flow in intangibles. We're happy with that. And so we moved through the process. We had some other financial assets. There was no movement at all. We can move on. Deferred tax. If you have a look at your deferred tax liability and you find, or your deferred tax asset or liability, and you find a net cash movement, then you have a problem because you should not be paying cash on deferred tax. So then you would have to go and have a look and see if you have correctly allocated, if you've correctly met, if you've completed your OCI notes correctly. So what happens on the deferred tax? This part would be fully automated, unless, of course, there was a business combination and deferred tax came in there, then you would just type that amount in. So where does the OCI get the amount from? So this would be, in our case, the deferred tax that arose on the revaluation of property, plant and equipment. So if we go and we take a look at our OCI note, I'm just going to access it through the statement of changes in equity, or you could F5 and search for it. So if I go to note 24, I'm going to come to my other comprehensive income. Remember, we dealt with that 2 weeks ago. And there was an amount of deferred tax that was raised in this note. However, that's not where the cash flow worksheet obtains its information. It looks to the total tax amount of OCI, so the 146,828, and that's going to come through as your non-cash movement on deferred tax. The other side was from non-cash through profit or loss, and that's going to be the deferred tax that was allocated to your tax expense for the year. So if you look in profit or loss and you go to your taxation note, there's your amount of deferred tax for the year, 32,485. And it was an increase in the liability, so it came as a credit. And so we see, if we minus our closing balance, that there was a zero cash flow on there. Right. Trade and other receivables, this would usually be opening balance minus your closing balance. If there was something like foreign exchange on your trade receivable, it would come out as a non-cash through profit or loss. So your trade and other receivables, since we have an amount here, you should know that trade and other receivables is a working capital item, and this is part of our operating profit. Our operating activities. So take a look at that 16 million. So if we go to our cash flow from operating activities working paper, and you just scroll down, the first part is just an allocation of the income statement. It's nothing that you have to do. It's literally, you would see it looks like the income statement, net profit before tax. I will come back to that. We take all of our non-cash adjustments out. You're aware of that. You normally start with net profit before tax, take out all your non-cash items. We're coming back here. Items which are adjusted separately, we're coming back, changes in working capital. So here we're going to bring through, it was our trade receivables. So our increase, decrease in trade receivables comes through here. And we've dropped it into the cash received from customers column. I'll talk about that in a moment. But what's important is that it lands up in the statement of cash flows column as part of our cash flow note, but it was obtained in our main worksheet, that's 16 million. Right, then let's go and take a look next at inventories. Also basically our opening minus our closing balance, but you would have recalled that we had a transfer from property, plant and equipment to inventories. So what happens in this case, let's assume that this is a motor vehicle dealer, and so they keep inventories of vehicles, but they could be included in their PPE, there could be demo vehicles or pool vehicles, which they then eventually transfer to inventories to sell. So that's what's happened in this case. Let's say there's about 5 such vehicles, and they were transferred to inventories. And so now, just take a look. Remember, we're out of balance by just over $1 million. So we're going to put the other side of the non-cash transaction now in where it belongs at inventories, and it was 1929966. And then that changes the amount of the cash impact of inventories. And then this again also moves to operating activities, part of our working capital movement, same as trade and other receivables. And there is that amount, and it was part of the, sorry, there it is, the inventories. It was part of our cash paid to suppliers and employees column, and it also lands up as an out on the statement of cash flows column. Right, so that finishes our assets section, excluding cash and cash equivalents. Then we're going to move on to our liabilities. I just want to first check in on our balance. So we're still out of balance, and we're going to try and work this to zero. So we're going to start off with our share capital, and we see we've got an opening balance and a closing balance, and we see that there's a net cash inflow of 2.5 million. Let's go check if we're happy with that. And you're obviously going to want to go and do some inquiries. Was this really a cash injection of capital, which it should have been? There we see there was an issue of shares of 2.5 million. We're happy with this amount. So if we go back to our cash flow worksheet, we expect to see the capital movement in our financing activities work paper. So again, like with investing activities, we've got our default where our little drop box is, where we just take the movement that was in the main worksheet. We then reassess whether we're happy it's proceeds or was it a buyback of share capital. We will do a reallocation if necessary, and then the final amount in the cash flows column is what goes to the cash flow statement. So in this case, we're quite happy that proceeds on share issue, that sounds good. It was an inflow, but let's say you had also done a share buyback in the year of, say, 350,000. Then you would put that in at this point. And it would automatically, the opposite would come out of the proceeds line, because remember the 2.5 is your net cash flow, and then you should land up with the correct amount that your proceeds would have actually been 2.8, of course your statement of changes in equity would have looked different, right? Then you would have seen 2.8 million in issued shares, and you would have seen 350 as a buyback or whatever it would have been. But this was a pure proceeds on issue, so that's correct. So we're happy up until this point. And so you literally go through the process line by line. We get to reserves next. Again, like with deferred tax, you don't want to see a cash flow on reserves. So if you do land up with a cash flow on reserves, then something has gone wrong, or there's a non-cash movement that has to be taken into account here. Bearing in mind things like transfers between reserves would then be included in your transfers and reclassifications column. So if there was a transfer you haven't taken account of, it might pop up as a cash flow movement. So as soon as you see something like that, which obviously can't be correct, then there's a non-cash movement to include. So what happened here is our reserves were impacted through OCI. So this, now again, if we go and look at our statement of comprehensive income, we know that there was a revaluation in this year, but there could have been other items of OCI. So if I go back to my other comprehensive income note, and I go to my net column at the end, and I go all the way to the end, that my total impact on I'm lying to you, but I'm not lying to you. So my total impact on reserves should come from this final column. However, one of your OCI items could also have impact retained earnings. So my direction is correct. It's just, it would be the total, but minus any of your OCI that affects retained earnings, because that's then obviously not a reserve. Okay, and the only such one would be your actuarial gains and losses on defined benefit plans. Other than that, your OCI items all affect reserves, and then it would be this total amount, 396,980. And there's a 396,980. It comes in brackets because it was a credit to the reserves. Remember, our property, plants and equipment value went up, it was a debit. So our reserves were credited, and you put your non-cash transactions in the same direction that they impact the line item. Then we've got our closing balance on our reserve, so there was no cash flow we're happy with. No NCI in this file. Our retained income, this is the one that's again a little bit different than the rest, but it's the same. It's different in the sense that we've split out the non-cash movements rather than put them in the retained income line. So our retained income is essentially our net profit for the year. So we start with our opening balance, which we get from our trial balance, minus our closing balance, and we get a total amount. If there were other items like dividends paid or transfers between reserves, those would have been captured as non-cash items here, so that the end result would essentially be then your net profit, but your net profit before taking out non-cash items in this case, only because we're going to take out the non-cash items below it. So if we took the retained income line, and then we took all the lines which follow, in other words, all the non-cash items included in profit or loss, and the items which will be presented separately, and we compress them up into the retained income line, they would all come through into this cell here, non-cash to profit or loss, and then our final amount would be our cash net profit. But we don't want to do that because we want to see the components split. Okay, so let's go and take a look at what happens. And again, have you noticed how little I've actually changed? So the most of what we've done has been automated. Okay, depreciation, impairments, reversals of impairments. So we know that this is a non-cash movement. This is going to come through from mapping. Again, remember I've said to you, for every non-cash movement, there must be a debit and a credit. So the other side of the depreciation and amortization, where was it? It sat in the PPE line and in the intangible assets line. You're happy with that? You can, of course, right-click, trial balance, drill down, and then you would see all the items that were included in there. Then we've got our profit or loss on sale of assets or liabilities. This was our 17,000 loss from that PPE. Where was the other side? Included in our PPE line. So you want to make sure that for every debit, there was a credit in this process. All these other items would basically be automated, probably foreign exchange, fair value losses, provisions, and so forth. They were not in this file. I want to draw your attention to other non-cash items 1, 2, 3. So it could be that you've got something that happened in profit or loss that isn't mapped or isn't a general type of transaction that we wouldn't know about as being non-cash. So the example I'm using is, remember I said to you that we received a donation of assets, and this donated amount was actually received as other income for the year at its fair value. So if I go to my other income note, I know it's not a material amount, but just bear with me. So there we've got donation received 24,580. It wasn't a cash donation, it was a computer. Okay. So what we're going to do is we will take our non-cash item, and we're going to this is only for the items which are included in profit or loss, because remember now we're taking out the non-cash items. So I'm going to go and I'm going to use the first one, and it would have been a credit, so we're going to put it in as a credit, 24,580. And you can even come and stand here just for your sake so that you can remember what it was later on, and change the name. So you're going to right click properties, and then you would go and you would say donated asset, for example. Okay. And let's just go and take a look at our balance. So again, our test of cash flow balance is reducing all the time. So now we know that this 24,580, we know that we've got our credit, and there was our other leg in the property, plant and equipment side. So we've dealt with all of our non-cash items through profit or loss. Then the next section, I'm just trying to decide if I should go straight to the, okay, let's first go and deal with this now, and then I'll move on to the next bit. So all of these items which come out, now I know these are non-cash flows, but remember, it's our net profit taking out our non-cash movements. If you can see a block around it, then it basically gives you your cash movement. So all of these then go to our operating activities working paper. And remember, then it looks the same as what we're used to seeing in operating activities. So we've got our net profit or loss before taxation. Look at the statement of cash flows column. And this is our net profit or loss before tax, which aligns with our income statement, adjusted for non-cash items. And these are the non-cash items which we just spoke about. They default into the column where they were originally included. So in our operating activities section, we've just taken the income statement and allocated between what would have been cash from customers or cash paid to suppliers and employees. And then, so when we take the amount out, we take it out in the column that it came in at. So depreciation, amortization would have been expenses, so we bring it out here. Profit or loss on sale, it was a loss on sale, so it would have come through in the expenses. The profit on sale would come out this side because it would have been included in this column originally. So we go through the process. Then you see there is our non-cash item, our donation received. We defaulted it to the cash paid to suppliers and employees. In other words, we assumed that it would have come out of expenses. But in this case, we know it didn't come out of expenses because we know it was other income. And other income, if I go up, we've just defaulted to the cash received from customers column. This is not a very big deal. This is just for your calculation to see how we got to our split between cash received from customers or paid to suppliers and employees. You can even turn that off in the face if you don't want to use it. It's just our allocation. But the other income column was on this side, so we're just going to move this to, because we know it was an income amount. So like I said, you've just got to change the defaults where you disagree. We could give it our best guess. So that moved, nothing changed in the statement of cash flows. It's still going to come out as 24,580 regardless. And so that was that first piece, right? We go back to our main worksheet, back to our net profit section, which was part of retained income. I'm just moving down. We've dealt with all of our non-cash items. Now we get from net profit, we're going to remove items which are presented separately. So we're removing these items from retained income closing balance, which are presented separately, because we're dealing with, remember, our starting point was opening retained income minus closing retained income. So we're just trying to say in that 22 million, what there should be represented separately other than non-cash items. So what we do is we say, okay, well, that will be interest income, dividends received, finance costs, dividend paid, tax, and discontinued operations. These are, why do I do that? Let's go to the financial statements. Let's go to the cash flow. If you go to your cash flow statements, I'm using the direct method. We've got our cash receipts from customers paid to suppliers and employees, and then after cash used in operations, we've got these separately presented items, your interest, dividends, finance cost, tax, discontinued operations. You with me? That's why we strip those out, because they're going to present separately here. Okay, so we've just created another column called items requiring separate disclosure. We could have just popped them into the other profit or loss columns, but we just wanted to separate them. So now you've got 1, 2, 3 columns on your cash flow worksheet that deal with profit or loss. It's just a visibility thing, okay? So we take our interest income out, we take, in this case, our finance cost out. This is the full amount that was recognized in profit or loss as interest or finance cost or tax. So literally, if you keep your eye on those numbers, and we go to the financial statements, and we go to our income statement, there's your investment income. So this would include dividends and interest. There's your finance cost, and there's your taxation. So it all comes out. We're taking taxation out here because remember our starting point was retained income opening to closing balance, which is obviously after tax. Slightly different than the note. Don't panic about that. The calculations work. So we take them all out, and then we're going to put them back in. So now we actually have a line. So up until here, we've adjusted our net profit. Now we're going to move to items to be separately disclosed. Now we're actually going to say how much of this should we show on the face of the cash flow. It's not necessarily going to be this, although it often is. So now we put it back in. So we say our interest income, we took it out, we put it back. Our finance cost, we took it out, we put it back. And I'm going to just stop there for now. You can see there's yellow cells for other non-cash profit or loss. I don't want to create too much confusion at this point, but if you've got an item included here, which is not cash, then you would adjust for it out here. A nice example might be if you had a loan and let's say you had to present that originally at a present value, which wasn't necessarily the initial amount, and you had to then account for notional interest on it or amortize it up to a present value if your actual interest cost wasn't the interest, the market value of interest. Okay, so I'm talking to notional interest there. If that was the case, and let's say there was such a transaction and there was R1 million of that, you would take it out here and then you would put it against the loan where it was raised in. Okay, so it would wherever be. That would then mean that the actual cash flow on finance costs was not what was presented in the expense. Okay, or it could just be that your finance costs were never paid. It was probably a better example is it was just accumulated against the loan and never actually paid, and then that would essentially be a non-cash movement between finance costs and the related liability, and that would reduce the amount that was actually paid in cash. Okay, so that's why we've got these input cells to adjust if there wasn't actually cash flow items in the interest amounts. Then we move on to the next one that I've got here is taxation, paid or refunded. Our dividends would work also in the same kind of way. The amount of dividends would just show in this line. And of course, if the dividends were not cash, they would also be brought out here. Okay, so now tax, The reason I've not brought my tax back to this column is because taxation now works a little bit differently in the sense that we are back to considering tax as a type of a liability because we know there's an opening or closing balance. So we just wanted to put it in the same column as what we've done with all our other assets and liabilities. Again, it's just a presentation thing. We could have put it here. We just wrestled with where to go and we just defaulted to this column. So there's no real science behind it. So there is our tax amount. And now you're all going, oh dear, but there's a mistake, because you can see that my interest came back, my finance costs came back, but now my tax, why doesn't my tax look right? And the reason my tax doesn't look right is because this taxation expense included deferred tax and current tax. My deferred tax I've already taken out to my deferred tax line. There was the 32,000. So the rest of it, the normal tax portion, came out in my tax paid refunded, because I'm not going to pay deferred tax, I'm going to pay normal tax. So the full taxation amount has been accounted for in the double counting. Okay, and then there was, in this case, there was no opening balance to my tax. This is the amount of tax that was levied through normal tax. I'll prove it to you, 507,000. I am actually in my income statement. Let's go to the tax note. My current tax was 507,949, which left me with a closing balance of the same amount, which meant that I've actually not paid any tax this year. But obviously, if that was a different balance or if there was an opening balance, then the movement would have been the tax that was actually paid. Okay, sorry, I don't think I've yet taken you to this in the operating activity section. So because I'm now finished with the operating activity section, let's go and follow all these amounts through, which will be presented separately. So in our working paper, operating activities, we've dealt with our non-cash items. So our items which are presented separately, again into the same place where they arose. So investment income we would have put into this column. Don't worry if it doesn't belong there, it comes all together out again at the bottom. And then the paid to suppliers and employees, we put the finance costs in there, but don't worry about it because it all together comes out at the bottom. It's just literally to show you the process from start to finish. Now we know that in our main worksheet, we also had tax coming out here. Why are we not bringing the tax out here now, or the dividends? Because our starting point in this worksheet is net profit before tax. If we had started at net profit after tax, then we would have taken the tax out here. Remember our main worksheet on top, our starting point was retained income, which is obviously your net profit after tax. So that's just why, but like I said to you, the calculations all work. Okay, so we've spoken about the changes in working capital and we've taken out our items presented separately. And then we get to our cash generated from operations. So everything we did above in these two columns was just to show you how we get to the cash received from customers and paid to suppliers and employees and our net cash flow amount. So that goes through to our statement of cash flows. And this is this section where all those amounts came from. If you go to the note, you will see, again, you can't adjust these items. All the amounts which we've discussed pull through to the note as you're used to seeing. So we've got our profit or loss before tax, we've got all our non-cash adjustments. Here's our other item included. So we would just say here that this was a donation of assets or whatever it was. And then we've got our items which are removed to be presented separately, our investment income and finance costs. Again, not tax in this instance because it's before tax. And then we've got our changes in working capital, which all came from the worksheet. Okay, so that would have covered all of our operating activities up to here. But now what about those items that are presented separately? So these amounts, I just want to go back to the main worksheet. I'm going to just quickly do a random adjustment, and then I'll undo it, of the finance costs because I want to show you. Let's just say the finance costs had included $1 million, which was only accumulated in the loan. Let's just say it was part of loans from group companies, and this was the interest on it. So let's say that there was $1 million. It was just accumulated to the loan, never paid. And so we take it out here as well. So now we can see that our actual finance costs paid was actually only $1 million. So there, now if we go, but remember our amount removed from profit or loss was $2 million. So if we go to our operating activities work paper, the amount removed for finance cost is still $2 million, right? Because that's the amount that sits in net profit. But how much was actually cash? Only the $1 million that was actually cash comes through. Okay, I just want to fix that, else it's, well, I suppose it will still balance because we've done the double entry, but it's not what happened here. So back to my operating activities. So our separately disclosed items come from the portion in the main worksheet for items disclosed separately. All of them we've defaulted to operating activities in this column called default other. Remember, we're still in the worksheet. If you decide, and it's your right to do so, that you don't want it in operating activities, you want to show it in investing or financing, then what you're going to do is you're going to then do the reclassification in that section. So if our interest income, we decide we want it in investing activities, we will then put that into our investing activities. What was it? 774564. So you'll go to your investing activities, to the line item, it was interest income. You can see for dividends received the same. And then it presents in the state, it shows you that it will present in the statement of cash flows in investing activities. If you go back to operating activities, it would have come out of that column, and so you'll see it will not show in the statement of cash flows. Our finance costs, let's do the same and say we want it in investing financing activities, 2076582. And then it shows as our final in the cash flow statement, but if we go up again to operating activities, it's no longer there. So that's how you're going to reclassify your interest, dividends, taxation to different parts of the cash flow statement. Let's just go and show you in the actual financial statements. If I go to cash flow, and we're nearly coming in for a landing, you will see our separately disclosed items in the current year are all gone. If we go to our investing activities, there's our interest income and our finance costs. And remember, this would be the actual cash amount that we worked out in the cash flow worksheet. All right, we've just got to complete the liabilities part of our main worksheet yet. At this point, we're still not in balance. So I'm going down past assets. We've done all of our equity, and we're now at our liabilities, but we're still not in balance. So let's go deal with that. Okay, so we've got loans from group companies here. We have an opening balance of loans. There were no, if there were any non-cash transactions, for example, that interest, perhaps it was just accruing the whole time against the loan and never being paid, we would have put that in here. And then we've left our closing balance. So it looks like in our loans from group companies, which means a liability, we are seeing a cash inflow of 10 million. So we must have taken all our non-cash movements out already. So this is a loan from, so it's going to be in financing activities. So we're going to go to our financing activities, look for it there, loans from group companies. So again, now you're going to assess if you're happy with our classification. So we've defaulted it into repayments of loans. The other option is cash advance received on loans from group companies. So you'll say to yourself, oh goodness, no, an inflow couldn't have been a repayment. So just bear with me, it must have been advances, 10,258,079. In a perfect world, right? So it just reallocated to the correct line. But actually what you're going to find would have happened is that there would have probably been more likely cash in and out, in and out, in and out through in this group loan. And you actually have to show your inflows separately from your outflows. So you will probably have some kind of a worksheet where you've actually dissected this 10 million into how much of that was inflows and outflows. Unfortunately, Caseware can't work that out. The best we can do for you is find out what your opening and closing balance were, how much of it was a liability, and that's going to land up in the financing activities, how much of it was an asset. Those group loans would land up in investing activities. And let's just go find group loans. There they are. So this would be the asset side, the loans receivable. That's the best we can do, the split you would have on your side. So if you say, we've done our work and we know that the cash advanced was, let's say, 15,386,000. Then it would just work out, and we know that the net amount must have been 10 million because you worked out in your worksheet above, you've taken all the non-cash movements out. That means that there was a 5 million that was repaid and 15 million advanced in the year, but our net movement was the 10. Okay, so let's leave it at this and say we're happy. How does that present on the face? Only the final column would show in so let's just make sure. So we're in our financing activities, loans from group companies. You see it was just the final columns that pulled through in the correct section. So your group loans are probably going to be an area of quite a bit of work because you are definitely going to have non-cash items to take out. And you're also going to have to allocate how much of your net balance was paid and how much was received. Okay, we still don't balance though. We've got a problem here and the manager's wondering when we're going to get it right. So our loans from group companies, we're happy that we've done all our non-cash movements there, which were in this case none. Trade and other payables, opening minus closing balance. If there were foreign exchange, it would have come through here. This would have then also moved to our operating activities in our working capital section. Trade and other payables, there's that 2.7 million. So nothing funny on our trade payables. Are we ever going to balance this set? The last that we've got is finance lease liabilities. Remember we said that we obtained an asset through a finance lease and that it was a non-cash capital movement. So if we increase the asset, remember I said a good way to identify non-cash movements is if one leg was, if the both debit and credit didn't go through cash, then it wasn't a cash transaction. So here under our finance lease, we know that we debited assets and we credited finance lease with the 846,958. And now we notice that our test of cash flow is in balance. And this looks more reasonable. Let me just also show you something. If you land up with a lease liability, so I'm going to put that amount back, look at what it's looking like. So this is also a nice place for you to analyze, does this make sense? 800,000 inflow. When last did you get an inflow from a cash inflow from a finance lease liability? That doesn't make any sense at all. That's a good indication for you that there's something wrong. Sorry. So we identify, okay, right, it was the non-cash addition. So let's just put that back. It would have been a credit to liabilities, 846,958. And this looks more reasonable. There was a capital repayment of 42,000. What I also want to say is that when you present your lease repayments, this is going to be only the capital cash flow portion should show here. Where is the other side, the interest that you repaid, that sits in your finance costs. So also if you go and you look, let's just do a drill down on these finance costs. You will see there's interest paid on finance lease. So we're happy that we've allocated the cash that was paid on finance lease correctly. You shouldn't include the interest portion here. Okay, so now we balance. This is going to also finance lease liabilities. That goes to financing activities. And there it is. Cash repayments on finance lease. We have just created another line for a bizarre transaction which we perhaps couldn't think of, where you would do a reallocation if necessary, but basically this would be on cash repayments on finance lease, and that would have completed our full cash flow. So if we go to the test of cash flow area, we are happy in our worksheet that we balance, it's 0. We look at our financial statements. We are happy that our cash flow statement is now also in balance. And that is basically what I needed to show you here. We did discuss last time how to move to an indirect cash flow, whereby if you would want to, you would just stand on your cash flow and, you would go to your settings and format. And everything's still going to pull through right. You could change it to an indirect cash flow. And then I'm just going to check with Ninka if there's questions that I needed to be, easy questions, Ninks, that I needed to be aware of. And I'm just joking. I can let her tell us about those in a moment. And you can see it's already changed on the face. We're just letting it finish executing. And then everything that was in the note basically then just pulls through to the face. Okay, so there we've got our net profit before tax now on the face. All those same adjustments. You would just unfortunately need to put our donation in here again. But the amount all comes through and we're still nicely in balance. Okay. Ninka, is there anything from your side before we close off?
Andrew had a look at this question, and it had to do with the loans. So I think I've got a bit of feedback. I don't know if it's on your side or my side.
All right. Let's see if they
mute yourself.
All right. If the client chooses to disclose their intercompany balances as part of a movement in operating activities instead of loans, how would you adjust for that, as it doesn't appear to be sections available? Okay, I'm going to actually say it on the face of it, offhand, we don't have a direct section for dealing with it like that. I would have to go, and I don't want to just throw out a solution for you here. It could possibly be dealt with in the other non-cash movements, or you could use one of the, and now I am actually trying to throw out a solution for you. You could possibly utilize then one of the other asset or liability categories. I think I'm going to rather deal with you directly, if that's okay. I don't want to create confusion, but that is definitely something that we can also take a look at. Okay, is there anything else? Ninka, is there anything else you want to add? Were there more questions?
No more questions.
Okay. Right, then if that's all, I just want to quickly jump back into the slides. See, it doesn't seem to want to give me my slides back. Bear with me for 2 seconds, otherwise I'm sure I can just talk to them. Right, I think I have managed to find them again. So with that, we're just going to ask, and we're going to post the feedback survey in the chat. If you will please just give us a little bit of feedback on the session, we'd appreciate that. And then we're coming to a close on the Get Ahead series. On the 7th of June, which is tomorrow, there is a probe audit section on conclusions in the work program. And on the 20th of June, Ninka and I will be back for accounting policies and the roll forward and update file. And so that's basically us. Thank you so much for your time. Thank you for attending. Thank you for staying. And we will see you again. Oh, just before you leave, please do connect with us on LinkedIn. And we'd like to get your feedback there and keep you involved and connected. Right, I think that is now us. Yes. Thank you for joining, and do have a beautiful day further.